Hi everyone, Donna here with Bookkeeping Made Simple, and today I want to talk a little bit about some of the things that come up when we're talking about bookkeeping and accounting. And one of those is inventory versus cost of goods sold versus supplies and materials versus work in process. And I wanted to kind of give you a really quick rundown of those and why it's important to track them with the budget a little bit. And I'm not going to go into a ton of detail because it's actually quite a complicated topic, but I do want to give you kind of an overview of the whole thing. So with that stated, as always, if you enjoy these videos, please like, share, and subscribe. I try to give out lots of good content so that you as business owners can really understand what your books mean to you. And of course, if you would like for Bookkeeping Made Simple to take care of the books for your business, we serve everybody in the United States. So feel free to reach out. All of our contact information is in the description below. So, and if you would like to be on the podcast, or if you have some ideas for the podcast, feel free to just drop that in the comment section. If you would like to be on the podcast, the link to sign up is in the description. We would love to have you. And of course, you can always call us at 801-692-0032, or you can email me at donna@mysimplebookkeeping.com. Now, jumping right in. Inventory is a complicated topic. There's a lot of things that go on when you're actually selling materials. Now, I sell services. I was laughing with a prospect this morning, and I said, I sell peace of mind, that your books are being done, they're being done correctly, that we care about our clients, that kind of thing. But I kind of wanted to get into the inventory and cost of goods sold aspect. The correct way of if you are manufacturing something, and that's where this really comes in. If you're a retailer, your inventory is going to go straight from inventory, which is an asset. And then when it's sold, it's going to go to cost of goods sold. There are some different ways of valuing inventory. There's first in, first out, which is my own personal preference. There's last in, first out, which can show a higher the word I'm looking for. It can show a higher net income without having any difference in the cash expenditures. I prefer first in, first out because it really is the way most people do things. You know, if I'm running a restaurant, for example, I want it to be first in, first out because I don't want the milk in the back of the case to just sit there and be the last one used. I want the old milk to be used first, rather than risk it going bad later. Now, and I feel that same way about everything from towels to sheets to cat food to whatever. So that's retailers. Okay, so we would value the inventory first in, first out. And then as soon as it's sold, we transfer the value of that to cost of goods sold, which then, so inventory shows on the balance sheet, cost of goods sold shows on the profit and loss, and it goes against the sales for that period. Very complicated, lots to do there. But I do want to talk about manufacturers specifically. And again, this is going to be a brief overview. I am not going to get into the weeds on this, but I do want to kind of explain it just a touch. When you're manufacturing something, widgets, we'll just call them widgets because that's what we always call them in accounting. You have to buy the supplies to put your widgets together. Let's say they're bicycles. Well, now you have to buy tires and wheels and frames and seats and chains and all the things that go into building a bicycle. When you receive all of those parts, it's not a bicycle yet. So we're going to accept that inventory on a first in, first out basis, probably. Most likely, because that's what's requested by the SEC if you take your company public, and it's a pain in the neck to change it later. So we're probably going to do this first in, first out. The other two methods for valuing inventory, like I said, is last in, first out. And there's also specific identification. So if you are a contractor and you're building $1 million homes, you're going to have that inventory specifically identified with that particular home. We don't have to worry about, Kellogg's is going to value their inventory differently because they are on an assembly line versus a custom home builder. So first in, first out is what is strongly recommended by the SEC, the AICPA, and the other trade organizations that accountants pay attention to. Not all of us are members of them, but we do pay attention to what their guidelines are because we are bound by those. Last in, first out used to be really popular. And it's more popular in inflationary times than in deflationary times because obviously the last one in, you're going to pay the most for. But first in, first out is considered to be most correct. Again, that means that if you buy milk today at $2 a gallon and you buy it tomorrow, it's $3 a gallon, then we're going to put the milk that you sold today, if you still have the $2 a gallon milk, we're going to value it at $2 a gallon until all that $2 gallon milk is sold. And that sounds incredibly complicated, even to me. And then, then we'll kind of move on to the $3 gallon milk. So there's a lot that goes into the inventory valuation. I'm not a huge fan of doing it because it is complicated. On the other hand, if you have milk that you bought at $2 a gallon, and then you have more milk that you bought at $3 a gallon, and you are doing last in, first out, we're going to use it the $3 a gallon milk first, and then the $2 a gallon milk, which really isn't accurate. This, by the way, is also why changes at the gas pump happen so often. The price at the pump reflects replacement value. So if they have a tank full of fuel that they are, and they do, they have like 3 or 4 tanks full of fuel under the ground at the gas station. And they know that they're going to have to replace that at a higher cost. They're going to price the gasoline at replacement cost plus their margin. So they're going to say, this is what it costs us to get it from the refinery, and this is how much we need to make to cover our bills and make a profit. So just in case you're wondering, and those futures on fuel, by the way, can change in an instant. They are, by the way, it's a commodity, so it's based on futures. And I can get really into the weeds really quick on this. If you're manufacturing, though, you're going to receive basically boxes of parts, boxes of supplies that you need to put it together to create a widget that you're going to sell. If you're selling bicycles, you need to take all your bicycle parts, put it together into a bike, a custom bike, and then you're going to sell that. It could be a custom bike, it could be an assembly line bike, but you're probably not making gears and brake pedals and everything in your facility. You're probably purchasing those from a supplier. So we will then value your inventory of parts that you're going to use to build something as we're going to call it inventory, and it will be first in, first out. Now, as you're building it, of course, there's going to be some changes. Okay, so you're going to be putting bikes together, assuming you're building bikes. The bikes that you're putting together, we're going to call that work in process. So we want to see that there's some bikes that are being built that haven't been sold yet. We want to see that. That also goes on the balance sheet. And then when you sell the bikes, those go to cost of goods sold. How much did it cost for all of everything that goes along with building a bike? And that needs to be accounted for as a cost of goods sold. So this is going to be your supplies, your materials, your workers, their labor cost for being on the assembly line, putting all this together. But it's not going to count things like overhead, your factory, things like that are not going to be included in that. So I've just had a couple of clients that have nailed me with some inventory related questions, and I wanted to kind of clear those up. I realize it's clear as mud, but understand that the inventory does go from inventory to work in process to cost of goods sold. Cost of goods sold is the final cost of whatever it is that you're selling. Again, if you're a retailer, it's going to be the cost per widget plus the shipping cost per widget, what it costs to get to you, to your warehouse. If you're a manufacturer, we're going to have to take it through the inventory to work in process, which is all the things that you're in the middle of building, to cost of goods sold, which will cover all of the costs that go into building whatever it is that you're building. It's a bit of a process. So we want to make sure that you understand it, at least a broad overview of it. Again, I don't want to get into the weeds, but it's kind of hard not to. And I did want to just review that really quick. There are a lot of processes that go into that. So that is, oh, the only other thing I'm going to say is we do like to have a physical count of inventory at the end of every fiscal year, depending on what your fiscal year is. Most people's fiscal year ends December 31st, but a few will have a September 30th ending. It can be at the end of every quarter, but there's usually, you have to explain that to the IRS to do that. And with that, I'm going to leave you as confused as you were before this video started. If you have any questions about it, please let me know. This is a difficult topic to tackle because there's so much that goes into it. It's been my least favorite subject that I've had to cover, but it's important because you do need to know what the value of the inventory you have. We do want to show that on the balance sheet. So with that said, I'm going to go ahead and end the video, and I will talk to you again soon.